The most dangerous financial lie in America was never told in a dark room by men in black suits. It was told in bright classrooms, in respectable offices, in bank branches with clean glass doors, in family kitchens where hardworking parents repeated what they themselves had been taught. It sounded responsible. It sounded mature. It sounded safe. Save your money, buy a house, get a job with benefits, put your money in a retirement plan, avoid risk, trust the experts. Most people hear those words and think they are hearing wisdom. What they are often hearing is an old map for a world that no longer exists. I want to begin somewhere that still shocks people when they finally understand what really happened. 1971, most Americans do not know that year matters. They know wars, they know presidents, they know recessions, they know election dates and celebrity scandals and the names of a few giant companies. But they do not know why 1971 still sits quietly inside their mortgage, their grocery bill, their retirement account, and the slow, uncomfortable feeling that no matter how hard they work, the system keeps moving the finish line. Before 1971, the dollar still had a visible anchor. It was tied to gold. Not perfectly, not forever, not in a way that made life magically fair, but enough that the average person was still living in a world where money meant something more solid than confidence and decree. Then the tether was cut. The dollar stopped being a claim tied to something scarce and became a claim backed mainly by the promise of the government and the willingness of the public to keep behaving as if that promise were enough. That was not a tiny technical shift, that was a civilizational shift, because once money becomes fiat currency, the rules of the game change even if the advice being given to ordinary people does not. And that is exactly what happened. The map stayed old, the terrain changed completely. The average worker was still taught to save dollars as though dollars were stable, still taught to think of wages as security, still taught to think of debt only in moral terms, still taught to confuse price with value and ownership with wealth and a house with an asset and a retirement plan with a plan. That is where the damage began. The public thinks inflation is simply higher prices. That is too shallow. Inflation is also a vote against idle cash. It is the quiet punishment of people who keep doing what they were told in a system that no longer rewards that behavior. If you work hard, save in cash, postpone joy, and believe the bank is preserving your future, then inflation is the invisible hand entering your wallet every year and saying thank you for your discipline. This is why I have always preferred ownership to cash beyond what prudence requires. Cash has jobs. Cash pays this month. Obligations. Cash handles emergencies. Cash keeps you from becoming a forced seller in a bad market. But cash is not a great long-term plan in a fiat world. A dollar that earns little while life gets more expensive is not standing still. It is shrinking. Most people do not feel that right away. That is why the system works so well against them. It does not usually strike with one dramatic blow. It erodes quietly, steadily, respectably. Now let us talk about what happened after 1971, because this is where the illusion became intoxicating. Credit expanded, consumer lending expanded, housing debt expanded. People were handed more ways to borrow than any previous generation could have imagined. Credit cards spread everywhere. Home equity became a kind of disguised temptation. People were told they were building wealth because the numbers around them kept getting larger. The house rose, the account balance rose, the market rose, the wages rose in nominal terms. It all looked like progress. But progress measured in a weakening unit can be very misleading. If your measuring stick is stretching while you celebrate being taller, you may be congratulating yourself for an illusion. That is one of the great dangers of fiat systems. They make people feel richer before they become stronger. The distinction matters. You can feel richer because the price of your home doubled. That does not necessarily make you stronger. You can feel richer because your salary rose. That does not necessarily make you stronger if the cost of being alive rose even faster. You can feel richer because your retirement statement looks bigger. That does not necessarily make you stronger if the underlying purchasing power, tax structure, and future obligations are all working against you. This is why I have always cared about cash flow, real ownership, and purchasing power more than paper pride. Paper pride is one of the most expensive addictions in finance. Now let us move to 2008 because that year should have educated the entire country. It did not. The lesson was visible enough, the understanding was not. People think 2008 was a housing crisis. That is too narrow. It was also a literacy crisis. It was a crisis of incentives, of packaging, of trust, of what happens when complexity becomes the disguise for garbage. Banks made loans to people who could not truly support the obligations. Those loans were packaged. Those packages were rated as though risk had been washed away simply by slicing it, labeling it, and moving it through enough hands. The public story was that professionals knew what they were doing. The deeper truth was uglier. A lot of people knew exactly how weak the underlying loans were and sold them anyway, because the fee machine was still running when it blew up. Millions of ordinary people suffered in direct, painful household ways. Jobs vanished, homes vanished, retirement accounts were cut savagely, confidence vanished. The people closest to the structure often walked away far better than the families who trusted the structure from below. That is the part the average person never quite forgets emotionally, even if he never learns the mechanics. He remembers that he followed the rules and the people selling the rules did better than he did when the rules broke. That memory matters because it creates distrust, but often not understanding. And distrust without understanding is not enough to protect you the next time. I do not like vague anger in finance. I like precision. The precision here is simple. The system depends on people not knowing what things really are, not knowing what money is, not knowing what debt is, not knowing the difference between an asset and a liability, not knowing who is really being paid in each transaction, not knowing whether the advisor is an educator or a salesperson with a better haircut. That ignorance is profitable to someone, always. Now let us talk about the most abused word in household finance: asset. People say, my house is my biggest asset. Sometimes what they mean is, my house is my biggest expense disguised as progress. That is a much more honest sentence. An asset, in the clearest sense, puts money in your pocket. A liability takes money out. A primary residence, beautiful or modest, usually takes money out. Mortgage, taxes, insurance, maintenance, repairs, utilities. And if it appreciates, the owner often feels wealthier without having any greater monthly cash generating power at all. That is not nothing. Home equity has value, but value and cash flow are not identical. And when people treat their residence like a productive asset, simply because it rises in price, they begin making dangerous decisions. They borrow against it. They consume against it. They mistake temporary paper gains for durable financial strength. That mistake ruined many households in 2008. It is still ruining people in quieter ways now. A rental property that produces net positive cash flow is different. A business is different. A productive asset is different. The family home may be emotionally priceless. That does not make it a cash flow asset. The distinction is not moral. It is functional. People dislike hearing this because they think it insults the dream of homeownership. It does not. It simply asks the dream to stop pretending it is a business model. That is a healthy correction. Now we come to another turning point most people never understood properly: 1974. This is when the retirement structure in America began changing in a way that should have terrified the average worker if he had fully understood what was happening. Before that, many workers still imagined a world where long service could produce a defined benefit, a pension, a promise. Something closer to the old employer saying, if you give us your best decades, we will help support your later years. Then the burden shifted. Now the worker got the account. The worker got the responsibility. The worker got the risk. The worker got told it was empowerment. That is one of the most elegant moves the system ever made. Take institutional responsibility, hand it to the individual, call it freedom, and then sell products, funds, advice, and hope back to the same individual, who now must carry the risk himself. I do not say that to mock retirement accounts entirely. A 401k can be a useful tool, I believe broad low. Cost investing is a sound approach for ordinary people, but a tool is not a guarantee, and a retirement account is not a pension, simply because people emotionally substitute one phrase for the other. The average worker was quietly told, now it is your job to figure out asset allocation, market timing avoidance, savings rates, tax implications, withdrawal strategy, longevity risk, inflation risk, sequence risk, and the general future of the capital markets. He was told none of that directly, of course. He was simply handed the structure and told to be responsible. That is not a small transfer. That is a large transfer of risk from institutions to households. Once you understand that, a great many things in modern life become more coherent. You understand why people are so anxious, why they overreact to market declines, why every new recession headline feels like an assault on personal dignity, why retirement no longer feels like a finish line and instead feels like a hazy personal exam for which no one ever gave the full curriculum. Now combine all of this: fiat currency inflation, housing sold as wealth theater, retirement risk shifted onto households, banks and advisors paid whether the public truly understands or not, and then ask yourself the central question: what exactly is the average person being trained to do? He is being trained to work for currency. Store some of it in weakening form, use debt for appearances, and hope that the institutions selling the products to him are also protecting him. That is not a wealth strategy. That is a dependency strategy with a nice tie on it. I learned early that the poor and middle class are usually taught to work for money, while the wealthy learn to acquire things that money can buy, which then generate more money. That sounds overly simple until you watch enough lives and realize how often it is true. The employee says, "I need a raise." The investor says, "I need an asset." The employee says, "I need security." The investor says, "I need control over a cash producing machine." The employee says, "I need a better salary to survive inflation." The investor says, "I need ownership in assets that can reprice with inflation or outrun it." Those are different operating systems. That is the real divide, not rich against poor in some theatrical moral cartoon. Different operating systems. One system treats time as the primary thing sold. The other tries to convert time into ownership as quickly as possible. One system treats the paycheck as the center of life. The other treats the paycheck, if it exists, as fuel to build something that eventually matters more than the paycheck itself. One system saves in ways that make the owner feel prudent while weakening him over decades. The other system asks what preserves and grows real purchasing power. This is why I have always said that financial education matters more than financial encouragement. Encouragement without understanding just helps a person walk faster in the wrong direction. Now, I want to say something about the word conspiracy, because people hear it and become childish. They imagine a room full of villains plotting with cigars and maps. Life is not usually that theatrical. The more durable conspiracy is simply a structure that benefits from public ignorance. That is enough. Schools do not teach money clearly. Parents often cannot teach what they were never taught. Banks sell their products, advisors sell theirs. Politicians reward short-term comfort over long-term truth. Employers shift risk quietly and call it modernization. The public remains financially confused enough that the machine keeps functioning. That is conspiracy enough for me, not a secret cabal. A profit model built on misunderstanding. And the misunderstanding can be corrected. That is the good news. But only if the individual is willing to go through the much more uncomfortable process of admitting that many of the responsible instincts he was handed may no longer be sufficient or may have been misapplied all along. This is where a lot of people stop. They do not want to question the house. They do not want to question the 401k. They do not want to question the savings account. They do not want to question the advice of nice men in offices who tell them everything will work out if they keep contributing and stay diversified. They especially do not want to question the idea that their identity as good people was built around following rules that may not have been designed to make them strong. I understand that resistance, but life gets better once the illusions become less important than the truth. You do not need to become paranoid. You do not need to become cynical in a useless way. You simply need to become more precise. What is money in this system? What is currency? What is an asset? What is a liability? What is really growing? What is only getting more expensive? What kind of debt makes you smaller? What kind of debt, if any, might make you stronger? Who is being paid in each transaction? What does this bank want from your cash? What does this advisor earn from your trust? What is this retirement structure actually promising? What part of your life depends on wage labor? What part depends on ownership? That is how adults take back control, not with outrage first, with clarity first. Now, if I were speaking to an ordinary family at the kitchen table, not to an audience looking for dramatic language, I would say this: do not put your faith in cash beyond what prudence requires. Cash is necessary, but excess idle cash is a wasting asset in a fiat system. Do not confuse your home with a productive business. Respect it for what it is, but do not ask it to flatter you into borrowing or spending like it is paying your bills. Use retirement accounts intelligently, but do not pretend contribution alone is a full wealth strategy. You still need financial understanding, tax awareness, and a broader grasp of real assets. Do not take financial advice from salesmen disguised as teachers, and above all, begin converting labor into ownership as early and as steadily as possible. A broad, low-cost index fund is still a fine tool for many people. A productive business is a fine tool. A rental asset with true cash flow is a fine tool. The precise form matters less than the principle. Own things that work while you sleep. Own things that do not require your body to be present every hour to justify their existence. Own things whose value is tied to productivity rather than merely your willingness to save weakening currency forever. That is the path. Not glamorous, not dramatic, but real. The greatest financial freedom in the world is not some fantasy of never working. It is no longer being fully dependent on the next paycheck to keep your entire life structure upright. That is what assets do when chosen correctly. They lower dependence, they widen options, they calm the nervous system, they let you negotiate with the world differently. The person with no assets is always asking for terms. The person with real assets can increasingly set them. That is why I never wanted people to worship money. I wanted them to understand it. You do not need to love money. You do need to respect the system it lives inside. Because if you do not, the system will teach you anyway. It will teach you through inflation, through debt, through tax drag, through false security, through retirement anxiety, through the slow humiliation of working hard and wondering why the numbers never seem to create real peace. I prefer learning deliberately. It is cheaper. So yes, the rules changed. They changed in 1971. They changed again in 1974. They changed in the way housing was sold, in the way retirement was marketed, in the way debt was normalized, in the way currency replaced money, while most of the public kept using old language for a new reality. And if you still live by the old language, you will keep getting old results in a world that no longer rewards them properly. That is the central truth. Not that the world is rigged beyond repair, not that there is no hope, but that hope without literacy is just a slower path to disappointment. Literacy first, then ownership, then patience, then real wealth. That is still available. It is simply unavailable to people who insist on calling liabilities assets, currency money, and dependent security. I have no interest in that confusion, and I would not advise anyone else to keep financing it. There is another reason this old map keeps failing people, and it sits in the emotional center of the middle class. People do not merely want stability. They want evidence. They want visible proof that all the years of work, self-control, delayed gratification, and social obedience have meant something. That is why so many terrible financial decisions arrive dressed as rewards. The upgraded kitchen, the more expensive neighborhood, the luxury truck, the private school that is less about the child than about the parent's private fear of seeming left behind, the vacation financed on a card because the family deserves it after such a hard year, the renovated bathroom that gets photographed more than it gets used. None of these things are automatically evil. That is not my point. My point is that they become dangerous when they are financed by weakening structures in order to create the emotional feeling of upward motion. This is how the modern middle class often gets trapped, not by open irresponsibility, by respectable overextension. A man does not say, "I want to become fragile." He says, "I finally want to enjoy some of what I earned." A couple does not say, "Let us quietly destroy our future optionality." They say, "We need a little more room." A parent does not say, "Let me turn my child into a financial argument." He says, "I just want to give them the best." The language is innocent. The arithmetic is not. This is why I do not like financial advice built mainly around moral permission. You deserve it is not a financial framework. You worked hard is not an asset allocation strategy. It has been a rough year is not a substitute for cash flow. The world is full of people using emotional truth to justify mathematical weakness. That weakness compounds. Then, one day, the same people are furious because the system is not working for them. In reality, the system worked exactly as designed. It rewarded institutions that understood the spread between what people feel and what numbers allow. This is also why I dislike the lazy divide between savers and spenders. The real divide is not between people who spend and people who do not. The real divide is between people who direct money and people who merely react with it. A directed life says this dollar has a job. A reactive life says, what do I need relief from right now? In one world, money becomes a worker. In the other, money becomes a tranquilizer. That distinction is enormous. It explains why some families with ordinary incomes slowly become powerful, while others with visibly higher incomes remain brittle, anxious, and permanently close to zero. It is not always income. It is often operating system. I would go further. I think a great many people are not poor in the way they imagine. They are strategically disorganized that can look similar from the outside. Both can produce a low bank balance. Both can produce stress. Both can produce shame. But the cure is different. A strategically disorganized person may not need a miracle. He may need a clearer hierarchy, stop financing appearances, protect liquidity, own productive assets, separate emotional wants from structural needs. Kill the worst debt first. Raise the savings rate by subtracting, not merely by hoping. Interrogate every fixed cost as if it were trying to steal your future, because many of them are. That is not a small change. That is a new life. The public thinks wealth begins when the income gets high enough. I do not. Wealth begins the moment a person stops asking, what can I buy, and starts asking, what can this dollar build? That question changes the world. The same paycheck can enter two households and create two entirely different futures depending on how that question is answered. One household buys relief, image, and social camouflage. The other buys time, optionality, and ownership. Only one of those paths gets stronger with age. There is one more trap I want to mention because it sits quietly under all the others. Passivity. People love saying they do not want to think about money. They say money stresses them. They say they are not good with numbers. They say they would rather let professionals handle it. Fine, then the professionals will handle it in the way professionals often handle things when their incentives are not fully aligned with yours. They will package. They will simplify selectively. They will soothe. They will give you the clean narrative that keeps your behavior cooperative, and you will pay for the convenience, sometimes directly in fees, sometimes indirectly in bad product choices, sometimes in much larger ways through a lifetime of not understanding what was happening to you. That is the hidden cost of passivity. You do not merely lose control, you lose interpretation. The world gets explained to you by people who profit from the explanation. I would rather a person know a few principles deeply than know none and outsource everything. Know the difference between money and currency, know the difference between an asset and a liability, know what inflation does to idle cash. Know what debt does when it funds consumption versus when it funds productive control. Know why broad, low-cost ownership is usually superior to complicated stories for ordinary investors. Know why liquidity matters. Know why fixed costs deserve suspicion. Know why the paycheck alone is never the whole plan. That is enough to begin. You do not need a PhD in economics to stop getting quietly harvested by a system that depends on your confusion. You need clarity and repetition. Most of all, you need the willingness to admit that some of the most respectable advice in your life may have been badly calibrated for the actual world you live in now. That is not betrayal. That is maturity. The worker who learns this becomes dangerous in the best possible sense. He becomes harder to exploit. He becomes less dazzled by appearances. He stops worshiping salary and starts respecting ownership. He stops storing too much of his life in forms guaranteed to weaken. He stops asking institutions to care more about his future than he does. He becomes the sort of person who can look at a bank, an advisor, a house, a retirement plan, a paycheck, a tax refund, a market decline, and a debt offer, and ask the only question that finally matters. Does this make me stronger or weaker? That is the real conspiracy break. Not exposing villains, exposing weakness in your own thinking before someone else profits from it again. That is what I would want people to take from all this. Not fear, not rage, structure. Because structure is what survives the next speech, the next cycle, the next inflation wave, the next recession, and the next clever sales pitch dressed as safety. And if you build enough of it, then one day something very interesting happens. The world still makes noise. The banks still advertise. The politicians still promise. The experts still posture. The market still fluctuates. but your life stops being so easy to shake. That is when financial literacy finally becomes financial strength. And that is worth much more than being told everything is fine while you slowly drift in the wrong direction.